Welcome to The Explainer. Today, we're tearing down a wildly volatile B2B e-commerce platform that basically has the entire investing world completely split right down the middle. We are putting GigaCloud technology, ticker symbol GCT, under the microscope. Look, this is a company that's totally disrupting the furniture and large parcel logistics market. And right now, well, it's sitting at a massive crossroads. So let's dive right into this paradox, because on paper, GCT boasts this absolutely mouth-watering PEG ratio of just 0.37, and that's alongside a massive 32% return on equity. I mean, if you're into growth at a reasonable price investing, these numbers are literally dream metrics. You're looking at a company with a PE ratio of just 11.7 and a return on invested capital of 23%. Just going by these figures alone, the stock looks ridiculously cheap compared to the massive growth it's pulling off. But here is the terrifying flip side. Over 13% of the outstanding shares are currently sold short, meaning some highly sophisticated investors are aggressively betting against it. The short ratio is sitting at nearly 4. To put that into perspective, it would take about 4 days of average trading volume just for those shorts to cover their positions. In the tech sector, that is a remarkably high short interest. And the real ticking clock for us today is that GigaCloud reports their Q2 earnings tomorrow morning, August 6th, right before the market opens. This sets the stage for a seriously dramatic showdown. We are either staring down the barrel of a massive short squeeze that sends the stock into orbit, or an absolute disaster if they miss expectations and the short sellers just pile on. But hey, before we dig into the financials, you really need to understand their flywheel. GCT leverages over 11 million square feet of proprietary logistics space across 36 fulfillment centers. We're talking the US, Germany, Japan, the UK, and Canada. They use this giant footprint to seamlessly connect Asian manufacturers with global buyers for large parcel goods. Heavy furniture, bulky appliances, the kind of stuff that usually gets damaged, delayed, or is just a total nightmare to ship. This creates this incredible network effect, where more warehouse volume drives better utilization, which then attracts even more buyers and sellers to the platform. It's like a giant self-feeding loop. Part 1. The hidden red flags. Okay, so the bearish argument really hinges on massive volatility. GCT carries a beta of 1.71, so it is wildly more volatile than the broader market. Guru Focus gives them a dangerously narrow 4 out of 10 economic moat score and a pretty mediocre overall score of 68 out of 100, mostly because they lack major brand strength. Add in zero dividend payout for safety net, a high 3.33 times price-to-book ratio, and that staggering 13.16% short interest we talked about. And looking ahead, well, analysts are actually projecting a slight EPS decline in 2026, down from 426 to 418. Honestly, it is no wonder analyst price targets are all over the place, spreading anywhere from $36 all the way up to $73. When the experts are this split, uncertainty definitely rules. Part 2. The spectacular green flags. Now, the bulls, they will immediately point you to the exceptional 32% return on equity. That is literally double Warren Buffett's traditional 15% threshold. If you plug this into the Peter Lynch formula, fair value comes out to roughly $99. That is almost triple the current price. You've got that microscopic 0.37 PEG ratio, incredible alignment with over 23% insider ownership, a massive Q1 earnings beat of 19.5%, and a fortress of a balance sheet holding $363 million in cash with a rock-solid 2.07 current ratio. Oh, and add in a 17.5% growth in gross merchandise volume and being named a Time Global Growth Leader. Seriously, it's no shock the consensus rating is a buy with an average target of around $56. Part 3. The ultimate Titan face-off. So who's actually right here? Let's run this battleground stock through our ultimate value gauntlet. This perfectly illustrates the massive divide we're seeing. Benjamin Graham demands an absolute margin of safety. Peter Lynch, he looks for growth at a reasonable price. And Warren Buffett, he seeks high-quality returns protected by a wide economic moat. Let's see exactly how GigaCloud fares with each of these legends. For a defensive investor like Benjamin Graham, the verdict is a hard pass. Graham wants a price-to-book, or PB ratio, below 1.5, so paying 3.33 times book value, that completely wipes out any traditional margin of safety. Plus, the current share price is well above the Graham number calculation of $28.50. Sure, it might be relatively cheap compared to its peers, but Graham relies on absolute thresholds, and GCT just doesn't offer the kind of asset-based protection he demands. On the flip side, Peter Lynch would likely slap a strong buy rating on this one. GCT's metrics represent a textbook, once-in-a-decade example of GARP, growth at a reasonable price. That PEG ratio of 0.37 is way below his threshold of 1.0, which screams extreme undervaluation compared to its 25% EBITDA growth rate. For a Lynch-style investor, finding a rapidly growing company trading at just a third of its calculated fair value is exactly the kind of setup you aggressively go after. Now, Warren Buffett, he finds more of a partial fit. He would absolutely love those 32% returns on invested equity and the fact that insiders own 23% of the business. Oh, he loves founders with skin in the game. But the problem is the defense. That narrow 4 out of 10 logistics moat against massive, deeply entrenched giants like Amazon or Wayfair, yeah, that keeps him cautious. Furthermore, gross margins are hovering around 23 to 24%, which falls quite a bit short of his preferred 40% threshold. He would definitely want to see a much wider moat before committing serious capital. Part 4. Earnings Preview and the Final Verdict. So, with that fundamental clash established, everything for this high-growth, high-risk opportunity hinges on tomorrow morning's data. Here is the exact checklist you need to be watching. First up, revenue. Can they actually maintain that blistering 32% growth? Second, the bottom line. Look for them to beat that 85-cent EPS expectation. Third, is the gross merchandise value accelerating? Fourth, and this is absolutely crucial, what is their 2026 guidance? Will they alleviate the fears of an earnings decline? Fifth, can they expand those gross margins to satisfy the Buffett-style quality investors out there? And finally, number 6, how is the short interest going to react? To make sure you catch our full breakdown of tomorrow's earnings results and see exactly which side of this paradox wins out, please take a quick second to like this explainer, share it with a fellow investor, and subscribe to the channel. Hitting that bell icon ensures you won't miss our immediate post-earnings analysis. So I'll leave you with this final thought as we wait for the opening bell. The fundamentals are exceptional, but the vulnerabilities are very, very real. Will the 13% short sellers get massively squeezed as GigaCloud continues its rapid growth? Or are those sophisticated bears right on the money about this company's narrow moat and margin pressures? What do you think? Do your homework, read those 10Ks, and let us know your take in the comments. I'll see you in the next one. Stay sharp.